The Ultimate Home Buyer's Guide Part 2, because Part 1, or when I record the whole thing, way too long. So if you missed Part 1, you can check it out up here. Otherwise, we're going to start Part 2. Stay tuned. Promise you, it'll be worth it. Number 12, what should I buy? Because you're going to jump back between forth, because sometimes I find a lot of people, they're looking for something and they're like, oh, I'm not going to do this, I'm not going to do that, because the grass is greener on the other side. You have to focus in on what your need is and what you're trying to do, because everyone has decision fatigue, especially if you're kind of like, I would say, when I say first world problem, you have money and you're not sure what's the best one, right? This is very common when a lot of our clients who gravitate towards this are like, oh, Zen, you do a lot of investments, right? So you must know what's a good investment. And they're like, oh yeah, I want a best investment property ever, but then it's for personal use, right? Because personal use, I find when you put that thinking on, like the hat, is very contradictory to the investment hat, which generally tends to be exact opposite. And I'll give you an example. If you want a great view, generally on a monthly carrying cost for an investment, it doesn't make any sense, especially like a parking spot as well, because yes, you buy the parking spot, it may help you with depreciation, but now you're paying maintenance on that parking spot every single bit, right? Or if you have a good view, that's for your personal use, but that may not necessarily be the best investment, because in 5 years, maybe something comes up, or like you just don't, the view doesn't sell as much because you pay a premium for it, right? So you have to really differentiate between personal and investment. So if this is for your home to live in, let's get to your needs first, and then I can give you some color on whether, like that area, that condo is a good investment or not, right? Because like we steer our clients away from like crappy buildings and crappy areas a lot, unless they want to. And there are actually valid reasons for that. The idea is you need to get your needs in first, and if it's for personal use, think about personal before you think about investment. Because generally speaking, like if you're holding this thing for like 5-10 years, it's very hard to lose money, right? As long as you can keep the mortgage payments going. So when it comes to like what you want to buy, let's just go with the first one, right? Like if it's your first home, generally a lot of times it's condo, right? So a lot of people buying a condo, if your parents lived in suburbs and you want to be downtown where the action is, where the nightlife, where some entertainment is, and like, Jays game, Leafs game, Raptors game, then you want to be downtown and you'll be close to work. So that's where the walking proximity makes sense, right? And then you have to think about the condo cost, the condo fees and all that stuff, right? So when it comes to buying a condo, a lot of people get a little bit confused in terms of how to actually navigate what you want to buy, right? And I'm going to pull up some calculations here for you. So I generally am of the belief that condos are, unless they're maintained very, very well, they generally kind of lose their value. So I'll give you an example. Like there's a lot of those like 20-year-old condos on Bay Street, which even if you refurbish them, generally don't sell very well because the maintenance fees are very, very high, right? So when you get past the point, I would generally say like, before parking your locker, your maintenance fees like 80, 85 cents a foot. That's getting a little bit dangerous high. You should probably get rid of it, right? So this is why it's important when you're looking to buy something, because at the end of the day, no one really cares about what the purchase price you're buying. It's more about what your monthly payment is. So I'll give you an example. If you were back to that $600,000 condo you're buying, if you were buying something that's $600,000, maybe a little bit older, and your maintenance fees is $500, your total net carrying cost per month becomes, let me make this a little bit smaller so you can see it. Your total net carrying cost becomes $2,200 or $2,274, right? And that's a $600,000 purchase price and $500 condo fee. Obviously, there's other things involved, but this is for simplicity. Whereas if you were to pay something a little bit more expensive, say $650 in a newer condo, where the maintenance fee is lower, say $650,000, but your maintenance is $350, now your monthly payment is actually $2,272. It's actually $2 less. But the important thing is when it comes to the amortization is that because you're paying a higher purchase price, you're actually paying down the property more, right? So if you were to pay for a lower purchase price because you're attracted to the purchase price on the condo side, know that the condo fee doesn't contribute to your wealth, right? Let me show you an example why I want to go that. So in this example, every single year that you own the property at the $600,000 mortgage, you're paying down about $11,800 of mortgage, right? So that means you've owned that property that much more before any appreciation. Whereas if you buy the $650,000 one, and we know that your monthly carrying cost is like net the same at $2,274 and $2,272, you've actually paid $12,780 of your mortgage down. So that's about like $1,000 of difference. So just because you bought a better investment, you're now $1,000 richer every single year before appreciation. because instead of paying condo fees that don't go to your mortgage pay down, you're actually paying down your principal at a higher purchase price. So these are things you want to consider when you're buying a condo, right? And when we talk about kind of like the amortization schedule, which is kind of like, interest and principal payment blended out, the reason why a lot of people buy a home, even though it's a little bit higher, is when you pay rent, it goes to the landlord and their mortgage. But if you pay the interest, the mortgage, you're on your own, even though it's a little bit higher, know that you're paying down some of your mortgage and it's kind of like a forced savings plan, right? Whereas if you pay rent, it really just goes nowhere. So when you're buying a condo, don't just look at the purchase price. You want to look at the kind of value proposition. And this is where you can pick something for personal and we'll provide you some color on whether it's a good investment or on whether you should move into a different asset price. Not because we're trying to sell you something more expensive, because at the end of the day, for you, it's going to be generally better because you make more money, right? And then obviously when it comes to kind of condos, the location is very important. You got to see what's being built around there, what kind of the other kind of like developments are happening. And when you generally do a condo, I find I always like to give a little color where when you go to new, you're smaller and call it quote unquote efficient, but your appliances become smaller as well, right? So like you go from the 30-inch appliances to the 24, especially with the newer ones. Whereas you go something older or, kind of like in between, which is like the 5-10 year age right now, you can still get the larger appliances and kind of like the U-shaped countertop kitchen. So that's more functional stuff. It's just against the wall. But at the same time, you still get some like the stone countertops and all that stuff. So you need to understand what's important to you and whether you want like a very functional kitchen, right? Because if you're the type of person that works late and you don't cook much, it doesn't really matter, right? Just get something great and you can get something newer. But if you do cook a lot, I can tell you from the fact that like some of these ovens and new ones, like you can barely put a cookie sheet in there, right? So you have to see the actual unit and the type of finishes they have and if it fits what you're looking for. Now, the other thing when it comes to the condo, it generally becomes the parking, right? Like I was saying earlier, needs versus want. In a perfect world, you should get parking, right? But parking adds a lot of cost to it. And if you don't need it, then don't get it. That's generally what I'd say, because it reduces your cost because you have to pay maintenance on it. But if you definitely have a car, it's going to increase your purchase price. So that's where you need to look into different pockets, right? So you're downtown. If you want parking, it's probably easier to find parking if you're in like the far east side by Canary or like the far west side by Liberty. But if you're in like downtown, good luck finding parking unless it's an older building, right? So you have to, factor in all those things in your search. Now, if you're looking for, say, a freehold home, right? Your entry point generally, maybe you stay at a home and you like staying at home and now your entry point is a semi-detached or like a freehold home, like a semi-detached in Toronto or like a townhome in the 905 and you may have a partner, then these are the things you really kind of think that's important, right? Like, are you going to be getting married here, right? Are you going to have kids here? Are the school districts are important, right? Are you going to outpace the bedrooms, the amount of bedrooms that you have, right? So you plan to have a kid, you and your partner live in one room, and then the kid has another, like a nursery, and then the other one could be an office, right? So that's your 3-bedroom town or the 3-bedroom semi in Toronto, right? Those are like $1.3 million right now, or they're like about $1 million for a townhome in 905, right? So you got to make sure that property lasts you probably like 5 to 7 years. And this is where like you got to have foresight, because I personally don't like transacting way too many times with the same people, because on top of like my clients paying like commissions and stuff, like you double up on the land transfer fee a lot. In general, like you're paying 10% of whatever you're selling the property at in terms of commission and land transfer tax just to move to the next one. So you want to kind of like semi-future proof yourself, right? Obviously it's not going to be your forever home, right? But if you're going to be in that area, call it, I'll just use kids. Right. So you have kids, they're babies, so you can find daycare is easy. But once you get into JK, which is like 3 or 4, then you need to put them into a good school. So you don't want to move them around during the school. So that house needs to probably last you, call it from JK to grade 6, which is like 8 years. So, I usually say like 5 to 7 years before you move. And if you plan to have kids at that point, or your family is coming to move in with you, then you want to make sure you have enough space, right? So like you make sure enough have bedrooms. If you're going to stay at home, you have an office or a den to work in. If your parents move in, maybe like the basement, that's just like culturally like the Asian culture. So you got to kind of plan for all of those and make it work. Because what I generally find is like if you're going to have like say 2 cars, then make sure you have 2 car parking spots, right? If you're planning on getting another car, make sure there's like street parking in Toronto, or there's a second parking spot in the 905. If you are going to start having a lot of kids, the powder room tends to be useful, like more bathrooms upstairs, or maybe you either want like non-tandem, like back-to-back parking spot. So those are things you really have to consider, because if you're going to have the house for like 5-7 years, right, usually circle around the school district, you want to make sure the house that you're buying makes sense. And which is where it's okay to stretch a little bit, because a little bit of stretching that you're paying for more, it may be out of your comfort zone, but it'll save you a lot more money, because at least the stretch is going to pay down your mortgage, like we were talking about earlier, as opposed to, let's just buy this because I can't get past $1 million price point. Then you're going to have to pay transaction costs when you move again, right? So these are things that like foresight from our end to kind of explain to you why you need to have all this kind of thinking, not because we want to sell you something more expensive, but because it's going to save you money, right? Land transfer tax only goes to the government. Right. So now it comes to what you're buying. It's like we have a lot of clients who are trying to buy their forever home. And I put forever home in brackets and quotation right now, because the forever home actually doesn't exist. What I find is, like, you move into something you think is forever. If you're progressing your career, you may end up moving a different home, right? So while you are thinking about forever home, you always have to think about where you're going to be in the next little bit, right? So if you're moving while the kids are kind of like between school, you want to make sure they're done high school, right? If your kids are in high school and you're moving, maybe you want to think about the fact that they're going to flock the nest, like leave the house. Do you need that much space, right? So this idea of a forever home, while it's great, like things do always change. And I find that when I talk to a lot of clients, they change. And I always say this, like life changes. They change for like 3 main reasons: kids, university and high school; 2, separation; and the 3rd, just like catastrophic events that I don't really want to mention. So like those are the things that make your quote unquote forever home not forever anymore, right? So the idea is to just think for the near term future that makes sense without triggering a move. But at the same time, you don't want to just keep buying something that is like a small transaction just to upgrade and get into somewhere else, right? So like if the idea is, you want to go from a 1+1 condo to a 2-bedroom, are you really making that much of a difference? Do you know what I mean? Like, you're just paying transaction costs, right? Why don't you just push a little bit more and go into a townhome that it fits for your future, right? Or it kind of, like you say, your kids are out of school, but for the next few years, you want to move them into a different area, but they're leaving. Does that really make sense, right? You're going to downsize, right? Because if you're going to downsize, say you're coming up to, the elderly age, you don't want to go up and downstairs so much, right? Maybe start looking at elevators in homes. They exist. So these are things you really want to consider when you're buying your first home. Now, obviously, the further and further down in life, it may not be your first home, but obviously these situations do come up. Now, another one that comes up when it comes to like kind of what you should buy is, should I buy something and fix it up? So the first thing I always say is, look, you're probably watching way too much HGTV if you really, really want to renovate something, because renovations suck. Like major time, right? So we've lived through a bunch. They suck. You don't want to live through renovations. It absolutely sucks. There's just no other words for it, right? Imagine having no kitchen, or contractors going in and out of your house all the time, and they're working on the house. So you don't want that to happen. Now, in HGTV, they show you a piece of crap, and then they cut scene, and then all of a sudden the house is beautiful. Obviously, it looks great. They tell you you're buying at a lower price, and then you put some renovation into it. Yeah, that's fantastic. Like most of the time, if it comes down to the math, I'd say every dollar you spend, if you do it correctly without over renovating, you can probably get like $1.50 to $2 back in like market value, right? So while it makes a lot of sense. But the problem is, if it's your first home and you're just stretching yourself to get to the 20% down and the closing costs, where are you getting the money for the renovations? Like, I know there's mortgage products out there where they give you 10% of your purchase price to renovate, but you still need the money, the 10%, because you got to pay the contractors and you show the receipt to the mortgage people to blend it in. So if you don't have the money, are you borrowing it from your lines of credit and credit card unsecured to renovate? Is that some risk? At the same time, like, what's your living situation, right? Like we talked about in point 10, right? Like, are you doubling up your rent? Maybe you can do it if you live at home, where you're not paying anything and you have some budget for renovations. These are all things you really have to consider, because as a first-time homebuyer, if you're barely scraping by, you're not going to have, like, to close the place, you're not going to have money for renovations. You might as well do a little bit later, right? So make sure you keep that in mind. Now, if you're upgrading from a condo to, like, say, a freehold property, and you plan to do some renovations because you're going to kind of quote unquote want a deal, you got to keep in mind, you need a place to live. So either you're paying rent or mortgage on the condo, and now you have to close on this house first, right? This new freehold home, before you do renovations, which means now you're paying rent and mortgage for the condo, rent or mortgage, and you're also paying the mortgage on the new home, plus you're paying renovations, right? So you got to make sure you get your finances all set up, because renovations tend to be very, very difficult. Then you also have, like, some of our clients, again, if you're a first-time home buyer, whatever, right? I don't think you're there, but like if you're trying to build a home, there's a lot of capital intensive, right? So anything that requires building and not mortgaging is very difficult. That's why, like, people who flip homes, they're taking on risk to make some profit, and which is fine, but they're providing an end product to someone who's willing to buy something that's turnkey. So when it comes to thinking about what you want to buy in renovations, those are things you want to keep in mind. Okay, 13. I'm a little bit more than halfway through. I think like an hour in. Oh boy, this one is going to be a long one. All right, so the offer process. Now, this is where you definitely want to work with a good realtor. Shameless plug, our team. But the idea is I'm not going to shame on all that realtors, but like most realtors don't do enough transactions, right? So you don't know the minutia of what happens. And while you can negotiate your own deal, if you have a good realtor on the side, you're generally going to come out better on top and how to navigate the different buyer or seller's market, depending on which pocket of Canada you're in, right? So in Toronto right now, we're very much seller's market. So everyone's going to be different in terms of what you need and what you want to do. But here are the just overarching things that we always tell our clients. Like, look, you know the process, especially if they're like holding offers. Don't be bamboozled by the list price. It's obviously not going to sell for that. Just keep in mind, like some realtors will try to like say, hey, you can buy at this price to try to lock you into a buyer rep. It's kind of shenanigans. So understand the language. Like you have pre-printed clauses from OREA in Toronto. And they're fairly standard, but it's the Schedule A languages of like how that works where you can actually get some benefits, right? So I'll give you an example. Like there was one of my clients where there was a pipe burst halfway through closing, and because we put the right language in there, it forced the seller to actually fix it for us. Whereas if you didn't have that language, you're going to get the house with the pipe burst, especially in like a seller's market where, you're going in with no conditions. You need to have these things protect you. That's why you need, again, like understand the language and the processes. And that's why you need a good realtor. Anyways, I'm not going to keep plugging myself, but I've seen good and bad. Now, the other thing is you go with the offer process. You got to know how to navigate the offer presentation because everybody navigates it differently. And if you haven't experienced navigating if you don't have experience navigating a lot of multiple offers, you have to know how to get about like what the pros and cons are. You got to certify checks, like conditions. You have to know how to navigate it. And if you're not putting conditions when you go look at the house, you got to see what to look out for because there's no home inspections and kind of status certificate, right? So all that stuff you need some good guidance on. And you know what? Like very, very rarely I'll say, well, you get the first property right away. You generally have a lot of learning curve because find every first time home buyer, lack of a better term, they're kind of like in cloud nine. They think everything's possible because it's a fantastic experience looking to buy your first home. But then once the hammer comes down and you're getting like smoked out by like $50,000 to $100,000 because you're like, oh, this thing's listed for $599. I'm definitely going to buy this. I'll pay $599 and it sells for like $700. They're like, oh, son of a, right? Like, there's a level of expectation, especially if you're going for your first time and you don't know what the market is kind of predicting, right? So you need to have kind of that experience and don't be upset if you don't get it on the first go. I would say it takes usually anywhere between like 3 to 5 to 7 kind of offers to actually understand it, right? And there's a lot of tactics that come involved. There's a lot of emotions that come involved. So just be mentally prepared for it. Now, 14 is the competition, right? So, this is kind of piggyback off of the offer. So when we say the competition, especially if your first home, like I'd say entry-level condos with good views and like nice layouts or like 3-bedroom semis in Toronto with like good school district, those are what every first-time home buyer is looking for, which generally means that a lot of people will be there competing with you, especially if it's done up really nicely, right? So if, you get nice quartz countertop, waterfalls down, new kitchen, open concept, nice views, backs onto the park, everybody's looking for that stuff. So be prepared, right? Like I think I got into a 27 offer melee last week on an East York semi, right? So you have to be ready for these. Like every first time home buyer is looking for that unicorn 10 out of 10. And some people may have lost more and they're willing to pay more money and you're going to get beat out. So if you're kind of waiting around for that 10 out of 10, just be prepared to pay for it, right? But sometimes I'd say like, you know what? 8 out of 10 is good enough because you can work around the edges. Like the first home you're buying, like I was saying, it's not a forever home. It's just you need to, 1, get into the market and 2, fit your needs, not your wants. Because sometimes you can't afford your wants, unfortunately, right? And if it does exist as 10 out of 10, it's probably too expensive, like I was saying, right? So just be mindful of that because I've worked with clients and like I'm not a very like salesy, pushy kind of person. It's just like logic, right? So I have clients where I say, look, there's probably going to be a price jump between month A and month B, right? I see it all the time. Seasonality, there's nothing by, this is probably 8 out of 10, you should buy this one. But then sometimes don't listen and they wait, I'll just wait for the first one. And when that wait happens, sometimes the price goes up like 3 to 5%, right? And it's not saying this to scare you and give you FOMO, but like it's actually something that happens, right? So like I have some clients who would have maybe say bought something for, call it $1 million, and then they waited a little bit, come like 6 months down the road, that thing's like $1.1 million, right? Now, granted, like, the spread is $100,000. When it comes to closing, you're only paying just like 20% of that, give or take, right? But still, it's that feeling that sucks, right? Like I find people who are very much in cloud nine, they want to buy something that's perfect. and they're waiting for that perfect, but until you get beat down a couple of times, like the market drops a hammer on you, you're not motivated to kind of get the deal done, even if it's like 8 out of 10. And while I don't, kind of push people towards that, you just have to understand that this advice I'm giving you is for your own good. It's basically like, I never want to say I told you so, but like, we're trying to get you in something that you're happy with and fits your needs, doesn't have to have all your wants, right? So this whole competition thing with the emotions and the buying and selling, this is why I didn't come up with this. I'm pretty sure it's a Remax thing, but like, they're like, oh, realtors are like part-time psychiatrists and psychologists and you have to do this. Sometimes I do see it because everyone reacts to losing very differently, especially if you lose by like, $1,000 to $2,000. And I've seen that happen sometimes. It stings sometimes, and you kind of just makes you not want to be in the market. And this is why you gotta like tough it out through. In doing this a long time, like when I started, it was very emotional even for me, because I was like, yeah, I gotta get my client something. But like, I've learned to kind of like detach myself from this, because you never know what happens come offer. And even with all the experience, like every so and so, like I'll still see something really random happen, right? Weird stuff happens all the time in competitions. So just be emotionally prepared. Right, 15. So the question is, in a very hyper-competitive seller's market, should you bully? My answer is yes. And the reason you want to bully is if you know what you want and it fits your needs and you have a limit, sending them an offer and getting a response is not the end of the world, because they're generally holding, like, when the listing goes up, like say Tuesday, Wednesday, Thursday, they're looking at offers a week later on like Tuesday or something, right? But if you're able to go in there on like a Wednesday and give them an offer that's good enough, and they may accept it because they haven't actually had enough buyers to feel confident about it. But at the same time, like say you're maxed at 1.5, giving them 1.5 doesn't hurt, because they either say yes or no. Because if they say no, you can always come back on Tuesday, right? If they're maybe very bullish on the pricing. But if they say yes, there you go, you got it. And the idea people are afraid of with bullies is, am I overpaying for something? And what I will say to this is, while you could be overpaying it by a certain amount, and you got to watch out for this on the appraisal side, right? Because if you buy something for 1.5 and the bank thinks it's 1.4, you have to bridge the difference. And this is where a good realtor will tell you how to get it done, and also have the good mortgage contact to get it done. But the idea here is, I've seen this enough where even on the listing side, a bully sometimes is so strong that you're willing to accept it because of the seller's opinion. But if it's a really, really good property and you wait it out till the offer day, what happens is that you go through different rounds of multiple offers, right? So it's the first round and you get two people like 1.5, 1.4 and 1.45, right? So they'll send those two guys back, and then if they come close, they may go over the 1.5, and this is where emotions get very heated, right? And when you're kind of like a difference of like $10,000-$20,000, it's a lot of money, right? But it's mortgage, you only pay 20% of it. When it gets to those emotional times during that days, that's where things go crazy, and that's where I find you're able to get more money as a seller, because you're relying on the market and the emotions of these buyers losing a lot, right? This is why I say you have to keep a level-headed and kind of be emotionally kind of stoic, right? So when you do a bully offer, you kind of put it out there already, like, look, here's my max. I'm willing to pay this much for it, right? Whether it's your mortgage max or what you're comfortable max, and you get to answer yes or no, right? So you can continue looking, because if you have to wait a week to see whether you're going to get it, you may lose out on different properties. So that's why bully offers I find are actually very, very strong, and I'm not afraid to make them. I've had great deals for my clients using bully offers, and they're very effective in like a market with very, very little inventory. But the problem is just like most first-time home buyers have a hard time grasping with that concept, because they always think they overpaid for something. Right? Like I'll tell you, like from buying a lot of properties, like the last 5 years, every single thing that we have bought personally, like generally we've overpaid a little bit, but the market has been great to us, and it just kind of works itself out. So like, that's what I was saying. Like if you look back for like 1 or 2 years, you're like, yeah, I may have a little overpaid, but in like 3 to 4 or 5 years, generally 5, right? You're like, should have bought more. Didn't really matter, right? Because the way that the price is going, it's not saying prices will go up forever. It's just, this isn't me getting into the macroeconomics and stuff, but like prices aren't going to fall anytime soon. So like if you pay over by like, 1 or 2%, it's not the end of the world, right? So bully offer is fine. But when it comes down to like a multiple offer situation, right? Like no one's happy at the end, right? The realtors are exhausted, the buyer side and the seller side. The seller thinks they left money on the table. The buyers think they overpaid. By the end of the day, the deal is done, and you as a buyer, you got the home, and you don't have to compete with other people. Because if in these multiple offer situations, right? Like say there's 10 offers, generally I would say on the listing side, when you're looking at this, half of them are crap, because the deals, like people don't know what's going on with the realtor side. But you'll have, say, 5 of the 10 that are actually real. So only one person gets that place. That means the 4 other people are going to look for the next one that you're looking for. Whether this is a nice view condo or the 3-bedroom semi, and the one you just missed out on sets a new precedent. So the next one that comes out, they want at least that one plus more. So when you're in a situation that has like, 10 plus offers, there's that many buyers looking for that same property. Just bully offer, get it done so that it doesn't outpace you. And this is what happens if you're kind of lackadaisical in this very tight seller's market, right? Now this changes the buyer's market. Obviously we can negotiate and get incentives done in kind of like what we did in like 2012, but it's just not that type of market right now, nor do I see it becoming that type of market anytime soon. All right, number 16, we're now going to get into the condition side, right? So we're still kind of talking about offers. When it comes to conditions, the first one generally is home inspection, right? And I'm going to loop in status certificate with this. The status certificate is more reflective of condos and condo towns or condo apartments. But the home inspection, you got to watch out for really is like if you buy a home, like everyone's like, oh, what if the house falls? Like if you're buying a 100-year-old home in the East York area or like, a 90-year-old home on the West End, like depending on what it is, like there's going to be some pros and cons anyways, right? But you got to know to look for the main things. Like if they say, oh, hey, there's a hole in the vent, you should patch it up. It's not going to the house is not going to fall apart, right? Or like if they say, hey, your outlet is not grounded, it's a quick like $130 electrician fix, right? But what you really should watch out for are the big components, which tend to be structural, right? Or kind of things that it's going to have an impact on what you're going to be buying and where they can get insurance for it, right? So things you should look for in like a freehold home tends to be number one, knob and tube wire, which is like a type of wiring that they used back, I think, in the 70s. And while they actually still work very fine, I have no issues with them, kind of like aluminum wiring. It's that insurance companies deem them as unsafe, and you can't get insurance if they know you got it. And this is important because when you get a mortgage, one of the conditions to get the mortgage is that you have insurance. So while you can get insurance for houses with knob and tube, your premium, which is like the insurance money amount you pay per year, which is called the policy, right, is like 3 times. So if you're flipping a house and like there's knob and tube and there's crap in it, generally like say instead of a $1,500 annual kind of insurance you're paying like $6,000. It's called vacant insurance or builder's insurance. So that stuff gets expensive. So you got to watch out for that. Another one is like mold. Look, mold is a bad thing, but it's not the end of the world. Like if you know what mold is, mold remediation could be like a few $1,000s, and it's just you got to spray it down with citrusinella. It's like bleach. It smells like bleach, right? And then it kills the mold, and then you get a certificate. You're good to go. So mold's not that big of a deal. And just an FYI, if you see little black spots on shower heads, that's not mold. That's just mildew. It looks like mold. Again, you can spray bleach. It gets rid of it. So like working with someone when you go look at a house to see what's important, what's not, is very important. And I would say not all kind of people you're working with, like realtors, will understand all of this, right? So it's not just about, oh, hey, here's a pretty backsplash, right? I only know this because like we've renovated houses and built houses, right? So another one is asbestos, right? So I was trying to explain this to my wife now. Asbestos is not a bacteria. Asbestos is a type of material they used to use, I think, in the 60s or 70s. It was this like magic thing that everyone thought was great because, it was insulated, it was soundproof and all that stuff. And what effectively is it's very, very thin, kind of smaller than a hair, micron things that they weave together. And asbestos is in tiles, it's in sidings, and a lot of things, especially houses that are in the 50-year-old, right? And while you have asbestos, and it still shows up a lot in home inspections, if you don't disturb it, nothing is wrong with it. So if you break like a tile that has asbestos in it, all the little small particle hair-like things fly everywhere, and it can cause cancer, and like you have a hard time breathing, right? Because it's a very small microbe that gets into your throat. But if you actually remediate it properly, then it's fine, right? The problem is just you have to get insurance for that to remediate it. And asbestos can get expensive to remove. Mold, not so much. Knob and tube, depending on whether the walls are ripped out, could be anywhere between $5,000 to like $30,000. And the reason is because you have to fish new wires through. It's very difficult. But if the house is like down to the studs, like, all the drywall is ripped out, it's pretty easy to remove knob and tube. So these are things you got to watch out for with like a home inspection. That, and also just like grading and water leakage and all that stuff. And again, this could be like a 2-hour thing if I just go through it, but like just in working in this industry for a long time and talking to my inspectors, these are things I picked up on. So the other thing you want to watch out for when you're buying a first home is a status certificate, right? So this is specific for condos. So a status certificate, there's 2 main things you got to watch out for. And this is basically kind of like your health check of a condo. The first one you want to watch out for is emergency fund. And I know some lawyers don't actually provide this, but the ones we use do. So if you want a lawyer, let us know. They basically do an assessment of hey, look, the reserve fund, which I would just call emergency fund, has to be healthy. What that means is if like poo-poo hits the fan, like say the elevator breaks, and the insurance doesn't kick in, you have enough money there so that you can make the repair. So I'll give you an example, like a really healthy building, say call it 600 units, you should probably see at least $1 million in the reserve fund. And the reason you want this is if there's not enough money in there and the property management deems it as kind of like, oh, hey, you know what? This repair is too expensive and we don't have enough money in the reserve fund, or we need to kind of increase this maintenance fee to rebuild it back up. What they do is they do something called special assessment. And what that basically means is like, hey, yo, guys, everyone, we have no money. Every single condo owner has to pay a proportionate share. And when you see a special assessment come down the pipeline, it generally means condo fees go up, kind of like I was saying earlier with the Bay Street condos. Like they go really high, and they very rarely ever come down. So it makes the condo very less desirable, right, when the condo fees are up. So you got to watch out for these reserve fund. The other thing you got to watch out for is generally like engineering plans, or like if there's planned kind of like inflation, or non-inflation things where it increases the price. So one of the things is like when you get a new condo that's like 2 years old, generally the condo fees are locked in from the builder, right? And has a really weak reserve fund. So that's what the maintenance fee looks really good. But then after a few years, when it hands over the management fee, it's not for every single builder, because like sometimes you go from like trad-out to trad-out management. That stuff is great. But when you go from like, say, I don't know if throwing it under the bus, but like builder A to like property management B, sometimes they deemed different things, or it was mismanaged by the builder, and the reserve fee, the reserve fund is very low, and there's an engineering plan of things you got to fix, right? Like deficiencies. Then you know that their condo fees are going to go up, right? So those are two things you got to watch out for. Generally, there's like a little minor stuff like bylaws, like, you know, whether it can Airbnb, you know, how heavy your dogs can be. All that stuff is very like minutia. And these documents are like 100 pages. So if you are working with us, we usually have a lawyer that can review it for you in advance of like multiple offers, because you don't really want to have a condition in there, right? Unless the seller is dumb or the agent's dumb and they didn't put the status certificate for condos ready, right? So these are things you have to understand. In a perfect world, you would want the conditions, but in our current market right now, you just can't afford to have conditions because like it's so competitive. So there's no condition on a home inspection, there's no conditions on status certificate, and then number 17, which is financing condition. So the reason why you want to work with a good mortgage broker is you want to know what your cap is, so that whether you have a pre-approval letter or not, you know you won't go past that amount, or even if you do, you just have the money to bridge the difference. And you don't want to put a financing condition in there, because if you put one in, generally in any condition at all, is that you have the ability to back out. So when you have 10 offers and you have a condition, they're not going to pick you, period, because if you can back out, they have to resell the whole thing and hold offers and all that stuff, and it looks really bad, because then people are like, oh, isn't a stigma? Well, how come this deal didn't close? So that's why when you submit an offer, especially your first time, it feels kind of scary. People tell you need conditions, which I agree, but in a market where it's a seller's market, you can't have conditions and win. Or so you can't have conditions and, sorry, you need no conditions to win. If you have conditions, you won't win. Right? So especially if it's like a product like all first-time home buyers are seeking after. So with the financing condition, you got to do all your due diligence first, which is why I went through like steps 1 and 9 or 10, something like that, to get you ready for this, so that you won't have financing condition built in. Now, obviously, if you do have conditions, you can sometimes win, but like you have to overpay. Right? So let's say the place is $600,000. Like if I was on the listing side selling, and you know there's a $600,000 offer with no conditions, and there's a $650 with conditions. You know what? I may consider $650 with conditions, because that's like almost 10% increase. But anything like say $630, I'm like, nah, it's not worth it. Trust me, because I've seen deals botch, and I always tell my clients like, look, go with the deal that's firm. What's that saying? Bird in the hand is better than 2 in the sky, or something like that. I forget what that is, but that's why you have to get your ducks in order before you start buying, right? All right, so number 18. So what happens after you lock something in, right? So you got something in, the first thing you do is woohoo, right? You beat all the other first-time home buyers. We got to start mobilizing the financing, the lawyers, and all that stuff, and we're going to drop off the deposit check. So in a perfect world, when you're doing multiple offers or a bully, you need to show the deposit that you have, because without going too much into the detail, like if you don't have consideration or like check, technically the contract's not void and all that stuff, and you have 24 hours to kind of put it down. So anyways, you want to have that down. But at that point, once you secure it, the next day you put the check down. And you start the financing process. So you got to go talk to the mortgage broker you've been working with, and they start what we call the underwriting process, which is why they're trying to get you a commitment from the bank saying, hey, we're going to give you this money at this interest rate at this amount because you have this much deposit, right? So you got to get that stuff going. And right now, like on a good mortgage broker, it's probably like 2-3 weeks. And then you have to get the appraisal side on it, which means that the bank or the lender has to go send some dude to drive by and make sure the house exists, look at photos, and get a gauge of the value of it, right? So these are all things you have to do right away, get started. Now, 19, we're going to talk about the mortgage right now. So for me, in first-time home, it doesn't really matter who you work with. So like mortgage lawyer and all that stuff. The whole purpose of how we structure it is, if you use our mortgage guys and lawyer guys who we've worked with before, like, and we don't get like a commission kickback or any of that stuff. It's just if poo-poo hits the fan, like I can pick up the call and be like, yo guys, we got to fix this. But if it's someone that I've never worked with before, it tends to be harder and there's no onus, right? Because like if I'm feeding these mortgage brokers and lawyers kind of like a fee, a constant amount of clients to get business, they're not going to want to botch this, and I get pissed off at them, right? So I have a little bit of leverage in that sense, contractors. But if you go up somewhere else, again, you can use whoever you want. It just becomes harder for me to kind of pull that lever. Now, when it comes to mortgage, you can speak with whoever you want, and you can like rate shop all you want, but just make sure you have something committed, right? So that you're ready to close, because if you don't close, there are penalties and late fees and all that stuff, and the lawyer fees add up. You don't really want to get into that situation, right? Like I was saying earlier, you just want to get the underwriting side done, which is like they've actually gone through all the due diligence. Some dude called the underwriter checks all your, income, your credit score to make sure to lend that to you, and then actually send you the document to sign. The underwriting's done, right? So you got to get that stuff and just get the mortgage going. And when you're doing this, especially if it's like a 30-day close, you want to get started right away and just get a good mortgage broker so there's no hiccups. Because I was saying at the start of the super long podcast, there are some mortgage brokers like, yeah, we can do it, right? But then they're like, oh crap, I didn't see this, right? Or stuff like that, or like maybe you didn't disclose something. You don't want that to come back and bite you in the butt, right? Especially this happens a lot when people have like least expensive cars. And I've seen enough deals die from bad mortgage brokers where, a week before closing, they're like, crap, Zen, this happened. And I'm like, great. It's very difficult to secure A lending, your TD, Scotia, CIBC, RBC, A lending within a week. It takes like 3 to 4 generally, right? And you can speed it up to 2 and 3. So if you kind of go with the mortgage broker that's bad and they botch the deal, then you're basically left with B lenders. So you're paying like, instead of like 1.5 or like 1.2 right now, you're maybe paying like 3% interest rate, and you have to pay a lender fee of 1% and then the broker fee of 1%. So there's a cost to having to come up with financing to close the deal last minute if you have a bad mortgage broker and you have to get someone good to come fix it, right? But there's only so many options when, time is not on your side. Now, I'm going to go through kind of like different things about mortgage brokers and mortgage specialists, and this could get a little bit confusing, but it's just good for you to know. So in the mortgage world, there's something called the broker channel, and there's something called non-broker channel. So effectively, back in the day, mortgage brokers had access to every single bank, so your TDs, your CIBCs, and all that stuff, right? But as of right now, October 2021, if you go to a mortgage broker, they will have access to private money, B lenders, and generally your first time, you're not going down that route. But if you go to a mortgage broker, they're generally going to have access to TD, which really good rates, but maybe not the best when it turns to qualifying in terms of how much you get. The mortgage brokers in the broker channel have access to Scotia. Scotia generally will have the best kind of like not rates, but like the ability to lend you more money. They're a little bit they make exceptions, but their interest rates are a little bit higher, right? So it depends on how much down payment you have, and that kind of changes. So the people who are mortgage brokers will have access to that stuff. I think they also have HSBC access now too, but I'm not going to get down this rabbit hole. I hate HSBC. But if you want a CIBC, BMO, RBC mortgage, or Tangerine, you have to go to the actual bank and you have to get a specialist for that. So these people who work at CIBC, RBC, and BMO, they only have access to their own mortgage products. And this is where in later down, I think in point 25 or 26, I'm going to explain like different mortgage products. Like TD Scotia is actually great for your first property, but like if you get to like RBC, they're great for kind of like stated income, meaning like you own a corporation, but you're not reporting much taxes. They're the guys who like, hey, you do 35% down and we'll lend you kind of based on what your, quote unquote stated gross income is, right? So you need to know which product is where. And like generally, if you talk to me about it, like I'll connect you to the right mortgage broker for it, because everybody's got a different kind of criteria for what they're trying to buy for first home, right? Like if you're international, BMO's great. We got guys who help a lot international. So again, could be a whole whack load of different mortgage brokers and different people you talk to. But if you talk to like a CIBC, RBC, or BMO, they only can sell you their own products. So it may not be what you're looking for. But if you talk to a mortgage broker who only has TD and Scotia, they may not be able to give you the CIBC, RBC, and BMO products, right? So again, kind of confusing. It's really scattered, but that's kind of how the mortgage world works right now. Number 20, your lawyer. So generally there's two types of lawyers. There's the volume lawyer, and then there's the ones who hold your hand, customer service, right? So there are a lot of lawyers out there who they'll just talk to you for like 5 minutes and you submit them the paperwork, and they just like are a paper mill, right? They just push out paperwork. You'll never talk to them, talk to their clerks and all that stuff. And that's just how the business is set up, but they will be the cheapest, right? So you can probably get some for like sub $1,000 to do closing. But then there's the lawyers who will provide you kind of like proper work sometimes, and like the volume ones that don't even do the title search because it costs money. But they'll hold your hand, they'll make sure everything's good, and if like poo-poo hits the fan, generally you can call them to kind of fix things up, right? So I have access to both. It's just whoever you want to. Generally, I am of the belief that like you want good people on your side, and I'll pay a little bit extra, but you may be different. So do with that information as you please. Now, when you retained a lawyer, if you're buying a condo, if you were working with us, we'd probably have a lawyer to review the status certificate for you, which is like the emergency fund and all that stuff. And if you use the same lawyer, it's generally to give you a break on the closing because they would have asked you for like a retainer to review the status certificate because it takes time, right? So that's something for you to keep in mind if you're buying a condo. You may want to get a lawyer to review the status certificate in advance of it, right? Now, when it comes to kind of a lawyer's job, what they really are doing is they're taking everything, all the money that's transferred, and they're putting in what we call a statement of adjustments, right? Which is a document that they give you maybe like a week before closing. And all it outlines is basically you as the buyer, you paid a certain amount of deposit, probably like 5% to, the seller's agent and their brokerage. And then they'll take the money that the bank's going to give you from the mortgage commitment and they put it in onto how much you have to pay the seller, because you're going to have to get money from the banks to pay the seller the full amount, right? And then they're also going to take money from, like, say, or you're going to give them a check, a certified check, after the statement of adjustments, because sometimes you need to pull money from your RSP. Maybe if you're doing 20% down, you take the 5% from the listing brokerage and you have to top it up to 15, which is where RSP comes from, or like savings or parental help. And then they also looped all that stuff together. And they'll also be doing your first-time home buyer like credits, land transfer tax credits, and all that other stuff as well, right? And especially important if you're doing pre-con as well, right? Because it's a really thick document, and there's like two types of closing. So when you do all that, you get a statement of adjustments, and what all this is basically it's going to plus or minus a little bit. So I'll give you an example. If someone has paid condo fees or a condo for the first month, it usually comes on the first, but like you close on the 15th. So the seller pays from, day 1 to 15, and you pay from 16 to the end of the month, right? So, but the seller has already paid for it for the whole amount. So you have to readjust it and you have to pay the seller back, like, they're proportionate, like half a month back. Same with taxes and any utilities that have been set up. So those are things that the lawyers does. And at the end of the day, they'll give you that statement of adjustment, which is like, hey, here's the amount of money you still owe to complete the transaction, and you got to go get that. So if you're doing an RSP, make sure it's there for 90 days and you just go to the bank, just a little piece of paper. I think it's standard across Ontario. It's been a while since I did mine. So you just check a couple boxes and they move your RSP money from the RSP account to like your checkings account. You can do whatever you want with it, right? You can even buy furniture. So make sure you have all that stuff ready. That's what the lawyers will do, and that's called a statement of adjustments. Now we're going to get into insurance. So I kind of briefly talked about insurance, number 21 right here. So I briefly talked about insurance, and the insurance side, you generally need it, a home insurance, to get mortgage. Now, if you're not getting a mortgage, you probably don't need it. And I was telling you, like, if you get a house that kind of like a freehold that has knob and tube, there's different types of insurance and there's different premiums for it, right? But the thing you're generally looking for in a very standard kind of condo one is just replacement cost of fire, right? So that's why it's not very expensive. But if you're looking for one for a house, you generally do something called sewer backup, which you want to make sure you have something covered. And I generally am of the belief that you should pay a little bit more of the premium, right, the amount of the insurance, to get a reputable company to actually insure. Because what happens is if poo-poo hits the fan, and I've seen this happen before, the insurance company will send what we call an adjuster to your house, and they're basically trying to poke holes into, whether this was stuff that was not maintained well, and they're going to try to deny your claim. So which means you have to pay out of pocket. So, example for like sewer backup, if you have enough sewer backup, say it backs up, usually there's like a limit of how much they give you depending on how big your house is. Because if you have a finished basement, say it's like $80,000 to redo it, and you don't have unlimited, say you're capped at $50,000, the insurance company will only pay you $50,000 for replacement cost to fix it, and you have to pay out of pocket for the rest for like the sewer backup, and there's no one else to get the money from. So it's good to pay a little bit more depending on what your comfort level is, what type of personality you have, to make sure that if something hits the fan, your claim is actually going to go through. So that's why it's very important to get a good insurance. Now, there's a whole bunch of different types of insurance. Every insurance company is different. It's a whole whack-a-mole. Like, I talk to my insurance brokers all the time, and sometimes even I'm so confused. So just talk to a good an insurance broker about it. And there's different companies, kind of like the mortgage broker space. There's guys who have different access to different ones. There's one who only works at specific kind of insurance companies, like Allstate, or like TD Melchmont has been pretty good. So just things to consider. All right, number 22, fixed rate variable versus, fixed rate mortgage versus variable mortgage, right? So I have a whole video about this, so you can check it out up here. But essentially, the easy answer is always go variable because things change, right? So, separations, maybe you need to sell a house or something. Maybe you want to invest, you need to break the mortgage. So the idea is that whenever you break a variable mortgage, it costs you 3 months interest. So on like a $600,000 property, it's probably going to cost you like $3,000 to $4,000 to break it. But on a fixed rate, there's like something called IRD, which is interest rate differential, which I'm not going to go down how to calculate it. But if you were to break a $500,000 mortgage after like 3 years, you're looking at like $12,000, give or take. So it's significantly more. So when you have things change on you and you have to break it, you have to pay that penalty anyways, and you lose money regardless. And right now, and most of the time, the fixed tends to be higher than the variable. So if you're paying more on a fixed to kind of quote unquote, and this is what they tell you at the banks, like, don't you want to secure your family's financial future and stuff? Like, you're paying more for the fixed anyways, and if you ever have to break it, you have to pay more money. Why do you want to get a variable? Or sorry, why would you ever want to get a fixed, right? So like, unless the fixed rate and you're never moving for 5 years, and trust me, people tell me all the time, but then things happen, right? Then you end up paying a lot of money. And I'm telling you this right now because a lot of my clients come to me like, oh crap, I should have listened to Zen. I should have got variable, but I got fixed. And they only learn after paying the penalty. So you don't want that. So you want the variable because you want flexibility and option. And also right now, the interest rate's really low. Now, the thing that people are having to say right now is like, oh, aren't interest rates going to go up, right? Yeah, they will. I don't think they're going to go up more than like 1% or what we call 100 bips, BPS. So the fixed rate right now is like, I think 75, like 0.75% or 100 or 75 bips higher than the variable. So you have to guarantee you're going to have 3 interest rate hikes before you even break even. And this is before we even talk about breaking the penalty on the variable versus fixed, right? So it generally doesn't make sense for you to go fixed, despite what most people are told. Like, I know previously when the fixed was like 0.5 higher, I think there was more fixed 5-year fixed than there were variables. But now that the variable is lower and people are starting to understand this some more, like I think more and more people are going variable. And without going to crazy macroeconomic trends, there's way too much debt for the central banks to increase interest rate substantially, right? We're not going to see 5% mortgage rates anytime soon. So I wouldn't freak out about that. So number 23, closing day. So this one's going to be short. Closing day. Congrats. Woo! Oops. You got your place. Generally, I would say don't, book a day out to go and start moving stuff on the closing day, because you never know when everything in the closing is going to be taken care of, right? Because the lawyers have to coordinate between themselves and there's banks and all that stuff and the wiring of money. And trust me, the whole shenanigans of like closing last minute, I've been through it. I'm not going to get down to it. But the idea here is basically the banking day ends at 6 o'clock Eastern time. In Toronto anyways, right? So just prepare to be there at 6 o'clock. Don't wait around for like 12, 1, 11 o'clock and like book a moving van and all that stuff, because you never know when it closes and you don't want to go into the property until it actually closes and you own it, right? So that's kind of the line you draw in the sand. Yeah. So you want to make sure it's closed. So what I really say is if you are going to book some time off, you kind of get the house ready and do it the day after closing, right? Now, when it comes to closing, obviously, if you've gone this far, you'll know, but you can't close on a weekend or a holiday. Most people will catch that by now, but like some people don't. So generally it's a Monday, Tuesday, Wednesday, or Friday. That's not a holiday. Okay. And the first thing most people do when they get their home is, or like even when they kind of secure the place, is you want to book the internet guy, because we can't live without Wi-Fi anymore. So you can do that again after the closing day and just get them in. Or if you really want them to do it right on the closing day, just do it after 6 o'clock, right? Now, that kind of wraps up the first 23 steps of the first-time homebuyer ultimate guide. These are a couple of bonus ones, which I'm going to get into, which is investment and Smith maneuver, and then I'm going to show you a sample calculation. So the Smith maneuver. Now, I'm not going to get too detailed, so you can Google this yourself, but the idea here is, and you can borrow money from your home to invest to get tax deductions, in short. Because in US, you can write off your mortgage interest, but in Canada, you cannot, okay? So this is why I'm saying that you want to get the proper mortgage product. So how you effectively do this is you get a mortgage that is what we call readvanceable. And the layman's term for that is basically, how it's showing you in the amortization schedule. Say you have a $2,000 mortgage payment, $1,000 of that is mortgage, $1,000 of that is principal, $1,000 is interest. So every single month you pay the $2,000, you pay down the house by $1,000. That bank gives you a line of credit automatically for $1,000, right? So that's readvanceable. That means every single month you get another $1,000 in the line of credit and go up, 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 right? And what you do is you take that $1,000, you invest it in something, whatever you're comfortable with, right? S&P 500, ETFs, index stocks, whatever, index funds. So what you do is you create a tax deduction on that, and then you get a higher tax return, and you kind of just put it back into the next months, and you rinse and repeat. And depending on how aggressive you are and kind of what your returns are in the stock market or whatever, it could be real estate, if you have enough money in the line of credit, you can actually pay your mortgage off really, really quickly. So instead of say maybe like 25 years to 30 years, you could pay it off in 13, 17 years. It's actually that powerful because it's compounded interest over time. The simple idea to look at it is your line of credit right now at the end of 2021 is generally be like 3 to 3.5%. So without calculating the tax deduction, as long as you beat 3 to 3.5%, which generally, like if you do the couch potato strategy, like you'll do 8%, you're going to get the difference between the two. So, 8 minus 3.5, you're going to get 4.5% bonus on top, compounded, and before your tax deduction. That's why you're able to pay the mortgage off really quickly at 13, 17. And this is what we specialize in, like the investment strategy. It's more of like wealth management. That's why we use real estate as a way to kind of plan where you're going to go and why we're different. And that's why our clients are with us for life instead of just jumping around. So if you want to do that, you have to go back to us and go get the right mortgage product, because not every single bank has that, right? So like TD has the Flex, I think. Scotia has the Step for that. I think BMO has one. I forgot the name of that too. So you just have to have the right product set up in place. And you also need to kind of have an idea of how you're going to invest the money, right? So again, it's a very good way to pay off your mortgage really quickly, but it's something you can start considering kind of when you're, done step 21 or something, right? Because the closing is ready to go. Then you can think about which finalized mortgage, right? Then the number 25 is investing. So a lot of our investor clients, especially when they find us for the first time, is they're like, you know what? I've held my house for a long time. It's gone up. I've paid it down. Very Asian thing as well. You double down the balloon payments, right? So now you own so much of your house, right? So maybe you bought for $500,000, it's worth $1 million. You've paid down $400,000. That means you have $900,000 in equity. And this is where we can show you how to refinance and pull out equity and buy homes so that you can start investing. And this is where it's important with your mortgage, because if you were to pull equity out, if you don't have a line of credit existing, you're refinancing, which means you're breaking the mortgage, which comes back to why you should go variable. Because if the market goes really strong, like the last 18 months or so, you can refinance hundreds of $1,000s really quickly, but you would have to break your mortgage for it. Hence, you don't want to pay the fixed rate mortgage penalty to break it. So variable always wins. So when it comes down to that point, it's not going to be right away unless you have a really big down payment, but you can start using the equity in your home to start investing, because I would say that's what 95% of my clients do. It's not that they have tons of money sitting around. It's just that they have made money because the market has gone up and they've paid down their home, and they're able to kind of use that money to buy something else, right? And 26, I'm going to show you a sample calculation, right? So let me shrink myself over here. Now, I'm going to go into this example here. I'm going to do, say, a condo, right? And then I'm going to call it a freehold semi. So if you were to buy something, say you buy $600,000, the taxes right now are probably, call it $2,200. Your condo fees, if you buy it a good one, let's just call it $350. So maybe your purchase price is $650. You need the 20% down to come up, which in this case is $130,000, right? Like I was saying, you're probably going to get 2% interest on a conservative side, but realistically, you can probably get 1.3 if you want. But this would just kind of change your calculus and how much you can qualify for, right? So you can see here, 2% is $1,900. If it's 1.5%, it's $1,794. So with that, there's one mortgage. Now, you want to be able to calculate what your total carrying cost is, right? So on a condo, you have property insurance, like I was saying, probably won't be more than like $30, but I'll say 50. Utilities, depending on which one's included in your condo. So like generally most condos have gas included, which is heat. The newer ones will have separate water and hydro, but the 5 to 7 years is just hydro separate. And the really old ones, like 20 years, is just all inclusive in the condo fees, right? So if you're looking at a $350 condo fee, you're probably paying water, which I would say is probably like $25. And then usually electricity, if it's like a small condo, you're not paying much, right, for heating, unless you're like running the dishwasher and the stove during the day all the time, which you may be because you're working from home, right? So I'll call it like $75, and there's no hot water tank rental here. So then you buy, these are all your costs. Then because you're buying in Toronto, you have to land transfer tax, so you get $8,400 in rebate. And then that means all in, you need about $145,000 to close this property, right? So that's how much it's going to cost you to close it. Now, if you are looking at what your monthly, we call it burn rate or expenses are, you're looking at about $2,500. So if you were to do less than, say, 25% down on this one, right? So less than 20% down, that means you're going to do, I think it was $35,000, right? So which is 5.83%. Then that means this changes this, it changes that, right? that means your mortgage is higher, kind of like what I was talking about in the first few points. But all of this stuff becomes consistent, and the taxes here, like I said, is divided by 12. So then you still get all of this back, but now you're like $47,000 into closing the property instead of 142, right? So for people who don't have kind of family help to get it done, this is actually probably the better route to get it done. But you just got to make sure that, the difference here of, $3,000 versus $2,400 of like say $580 a month is not going to make or break you, right? So this is why you got to kind of, play out the scenarios and which works for you. Now, if we're doing say a semi, say a 3-bedroom semi, like 1.3, your taxes are probably, call it like $3,800. Now you have no condo fees. And because you're at the 1.3 mark right now, you have to do 20% down anyways, right? So maybe you get like 1.5 interest rate. Your property insurance is probably gonna be about $75 to 100. So say 100 on, and you have to pay for all your utilities here, right? So your water bill is probably like on average in a year, like $100 a month, because higher in the summertime you water grass, sometimes you don't. So say $100. Your gas bill, I'd say average $80 because higher in the wintertime and not as high in the summertime because you'll be using more AC. And electricity is probably like $100 as well. And with the house, you generally have to have a hot water tank rental that you have to inherit when you buy it. So that's probably like $30 on the older home, $50 if it's a newer home, right? So then all in, you're looking at about $306,000. And if it's your first home, make sure you have that money ready. If you're selling something, that's a whole different conversation, not first time buyer. But all in, you're probably looking at about $4,300 a month to kind of keep this going, right? So this is kind of an idea of how the sample calculations we do for our clients. If you want this calculator, you can reach out to me. I'll put a link in the description and you can kind of ask me for it. I'm happy to share this with you. So this kind of wraps up the idea of the ultimate first-time homebuyer guide. Holy crap, I'm just looking at this. It's an hour and 45 minutes. For the record, I took 2 breaks. My throat is a little bit hoarse now. But yeah, hopefully this kind of goes through step by step every single thing that you may have thought of, or even things you haven't thought of as well. I can go through and kind of shine some light onto the entire step of like buying your first home, because it is a lot, but congratulations if you're thinking about it. And if you are looking for some help from the realtor side and you want access to say our mortgage brokers or lawyers and insurance brokers, you can work with me. I'll put the link in the description. You can book a call. It's www.chatwithzen.com. And hopefully you guys found this helpful. Let me know if you like this type of super long form content. I can do this something for investment as well. But at the end of the day, you got to make sure, like I've come back to the first one, why are you buying the first home property? Because all of this stuff I just showed you is very nice, but it's the emotions and the reasoning of why you're making this move to actually do it, because it is a lot, right? But if you guys are ready, reach out to us. It's www.chatwithzen.com. We're going to have a 15 to 30 minute chat about kind of what makes sense for you. And then you end up working with our team to kind of navigate to your first home and then all the steps we're going to show you from 1 to 26 up to the investing point as well, right? So hopefully you guys enjoyed this. Again, let me know in the comments below whether you like this form of content. I know it's long, but hopefully you went to the timestamps and maybe look at what you're looking for. Until next time, your move, your future.